day, fellow investors. Today I'm bringing to you Ternium S.A, another Latin American company. It's a vertically integrated Latin American flat steel leader with strong integration and long-term partnerships. Management is conservative and long-term focused. All of this is given because they are majority controlled by Techint. More about them later. They have an estimated intrinsic value by me around $61, but take it with a grain of salt because there are many risks and it's a cyclical business, so you have to discount for them. As said, vertically integrated flat steel producer focusing on industrial, construction and auto sectors. It's a regional leader in Latin America. It's Luxembourg based and listed on the New York Stock Exchange. They have a long-running Brazilian lawsuit from 2012 over control and governance disputes between Ternium and Nippon Steel. It's still unresolved, although Ternium is denying wrongdoing but maintaining legal provisions on the balance sheets just in case. They are focusing on growth in Mexico to secure upstream supply, meet auto demand and strengthen North American integration. This is key given the NAFTA or the updated NAFTA. You should expect a lot of international and US firms to build autos in Mexico and sell to the US. We'll see how that works out. They are betting on it and keep going forward. From a shareholder perspective, you have a lot of skin in the game. So the key controller shareholder, Techint Group, is a multinational industrial conglomerate founded in Italy in 1945, now headquartered in Luxembourg and Argentina. It controls not just Ternium, but Tenaris, which is a steel pipes business, and a Tech Petrol energy business. So it operates across steel, energy, engineering, construction, and has a long-term conservative ownership model. The philosophy of the group is industrial integration and strong balance sheets and reinvestment. So they are really cautious shaping future strategy. Actually, the group is all owned by the Rocco family, who are the ultimate beneficiaries. And Paulo Rocco serves as also chairman and CEO of both Techint and Tenaris. So the family leadership actually spans generations and known for a hands-on management, long-term commitment to industrial asset style. From a management perspective, I really like this. You have skin in the game, and then only 21% is floating on the public for the public. On a regional distribution level, this is steel shipments. You can see majority dominated by Mexico, followed by Brazil and other South American regions. Other category includes US. I think a couple, like 2% or something. So explicitly steel tariffs to the US is not big. They use the steel in Mexico to make cars, and they sell the cars to the US. So not they, but their partners do. So it's not, oh my God, if the tariff on steel goes up even more, then they're gonna have any issues now. Let's look at the first half year. You see the profitability collapsing, going down. Although 21, 2, and 3 were exceptionally good years. But this is purely because of steel prices, as you will see later. In the meantime, you can see their capex were rising year after year. And this is first half of 24 to first half of 25. If you just annualize this number, it's $2.6 billion. It's way higher than 24. You would expect them to be, if I just said they have a conservative long-term commitment and asset allocation, strong balance sheet. Then why do they expand when profitability is going down? They should invest when profitability is going high. No, maybe not true. They are expecting probably an upcycle in the next X years that would justify these extra capital expenditures. So we'll see if that materializes or not. From a Moat perspective, they have vertical integration, customer lock-ins, and a group backing. These can all help them to keep costs lower, keep partners, and weather financial issues, which they are not likely to have given their balance sheet is rock solid, but they also have other expertise within the group, so they don't have to work with outside partners, reducing their risk there. From a management perspective, it's controlled by Techint Group, so they vote in who they want. This is like a family business that you can take a part in as a public shareholder. They're gonna nominate most of the management. They have no formal dividend policy, and their incentives are tied to net equity, management incentives. So they really focus on not going bankrupt and going for the long term, and not short term capital gains and stock options. They don't even get stock options on management, so that's a good thing. On a shareholder remuneration history perspective, you see that they are paying, orange is the dividend, purple is the free cash flow. You see that they are paying nice dividends, especially in good years. This is the stock price. Of course, the stock price works like other commodity stock prices. When the steel price is going up, which you will see on the next slide, the stock price goes up, free cash flow goes up. What they do then is they pay down debt. Nice. Cyclical company has to be able to do that on the upcycle, and pay dividends. So they don't do any buybacks, which is good. As I said many times, commodity companies tend to buy back their shares when they have a lot of free cash flow from high commodity prices, just exactly when their share price is already high because of high prices. So that's a capital destructive move. They are not doing that, which is great. From a margin of safety perspective, on steelmakers, we can compare their free cash flow. I have a couple examples here: Ternium, Gerdau, ArcelorMittal, Nucor, Cleveland-Cliffs, and Nippon. What I would like you to see is that on the red, Ternium is never really making a negative free cash flow. 24, they had 41 million, so that's basically nothing because they had a lot of capex. But they are not making losses. So that's why they can have a nice balance sheet, because in the worst years they still make some money, which is not true for Cleveland-Cliffs, which is not true for Nippon. Although, and Nucor is profitable, so you can pick other companies from this list. Maybe I will do maybe a Gerdau analysis later. They don't have too much debt, but you also have to keep in mind valuations for a cyclical steel business. For example, Nucor is highly priced, outstandingly highly priced compared to these, but that's because it's a US player, and also they are in scrap metals, so that's a bit different actually. But you can see they usually have free cash flow positive years, even the down cycles. From a margin of safety valuation perspective, I excluded 24 because they had a huge capex expenditure, and I only looked at the years prior to see through the cycle. You can see that they have maybe a $61 intrinsic value. If you look at the 10 cap price of the average years, what does it mean? You average out all these years, and then let's say it's $1.3 billion. Let's just say that, probably higher, 1.5. 10 exit, 50 million, that should be the market cap for this business if you want a 10% rate of return. So if you look at 23 alone, that would be a $53 price. So $10 million market cap divided by the outstanding shares, 53 per share. It's hard to do projections on a cyclical business like this. You can look at the past years, average out what they made, and then that could serve you as okay, what could this make over the cycle? That's what I would say. I think I would say 61 might be a bit too optimistic. We could probably use 53, and maybe if you pay 53 and you get a 10% free cash flow yield, maybe you even don't want to pay that. Maybe you want to pay 30 or less, so you have a higher return, because this is a cyclical business, and how you play a cyclical company is that you either buy it, you want to buy it for a good price, which is on a downturn when everything is bad, everybody's going bankrupt, the business is horrible. That's when you buy a cyclical business, and when the upswing happens, that's when you sell it. Option none. Option 2 is you just keep it. You buy it really cheap, and then you ride through the cycle. You don't care. You get your dividends. If you pay $20 for a Ternium for life, you will get a really nice yield, like buying a US Treasury in 1980 at 15%. You just hold that 30-year Treasury like your life depends on it, and then you get your cash. They have a solid balance sheet as a cyclical, and with a private owner, basically, it's a must. They are moderately profitable. So 7-year average is 13% if I exclude 24 because of this. This is also a 23 number with this. They are not outstandingly, so they are not like an Evolution AB I talked about the other time, which has a 50% return on tangible assets and like a 30% return on equity. They are an okay business. They are not an Apple. They are an okay business. You buy, and then a good business might not be a good investment. So if you have this business and you can buy it, let's say 2 times price earnings ratio, it's gonna be a insanely good investment long term if they don't mess up somehow. But so even a okay company at a good price can be an amazing investment, but a really good company at a really high price can be a really bad investment. So there are many risks, right? So they have the steel cycle, they have to follow prices, they have the US tariff situation, not as much with steel as much with the second order effect. So if Mexican built car makers cannot export to the US because of this or that slows down, they cannot sell as much steel. They have project execution risks, right, in Mexico with the new expansion, although given their history that might be not even necessarily to be on this list. They have a general like Latin American macro and FX exposure. They work a lot with industrial real estate. So wherever they need steel, they need a good macro background in the given country to grow. If they grow, if they are having a good macro environment, they are growing, then they will have more demand for steel. And of course, FX in Latin America is always a first to drop when you have a global risk off attitude. If there is a huge global recession, you will see capital move back to core markets like Japan, US, Switzerland, Europe. So that's something to keep in mind. And they have an ongoing litigation in Brazil since 2012. On the stock summary table, you can see all the companies we have analyzed so far. You have Ternium here. Technically, you have an almost 70% upside, although I would discount it more. That's also true for other companies like Petrobras. They have risks. Maybe you want to discount it for. So you don't want to pay the the price which gives you 10%. You want to pay half of that, which gives you 20%. Then you are compensated for the extra risk you get, you expose yourself to. And that would be it. If you enjoyed the video, please like and subscribe and leave comments for me to pick stocks for you and analyze stocks for you. I have a list, I think like 25 companies to go on the list, but I can always just follow the comments. And thank you and have a nice day. Take care. Bye bye.